Hey there, everybody. I hope you're having a fantastic day so far today. My name is Laura Bolio, and I'm the VP of Marketing here at Holistiplan, and I'll be coasting with Debbie Taylor and Jen from Taylor Financial Group today. So if this is your very first time at a Holistiplan webinar, you are in for an incredibly special treat. If you've been with us before, welcome back. As always, our goal is to bring you the absolute maximum value possible. Holistiplan's #1 mission is to help advisors provide richer financial planning to more clients. And so today, we're talking all about those critical tax planning opportunities that surface towards the end of the year with none other than Debbie Taylor herself. And it's my great pleasure to introduce to you my dear friend, Debbie Taylor, or as we call her, Queen Debbie here at Holistiplan. Debbie is the founder, wealth advisor, and lead tax planner at Taylor Financial Group, which is a full-service, woman-owned wealth management firm. She is a highly sought-after industry speaker, and she leads our Holistiplan monthly masterclass, where hundreds of advisors tune in each month to unlock the secrets to tax planning success. So before I hand it over, yes, this session will be recorded. Yes, we will send out the slides after the webinar. If you have questions, drop them into the Q&A and we'll do our best to respond to them as we go. And with that, Debbie, Jen, I'll hand it off to you.
Thank you for the kind words, Laura. We're thrilled to be here. And I love the Queen Debbie because I just got back from London a week and a half or 2 weeks ago and still basking in the royal glory. So thank you. Thank you for that. And I have to put a little plug in for Nitrogen coming up in about 2 weeks. So we're going to be there. Laura, the team, my team's going to be there, and Holistiplan's going to be presenting. We have a whole pre-conference and then a bunch of breakout sessions. So it's not too late. It's in Nashville, which is one of my favorite, new favorite cities, and I'm really excited for that. Okay, so hopping in for today, it is the season, right? We are in Q4. And so time for all of us to really, really put on that tax planning hat. As all of you know, I do believe tax planning is a year-round activity. So it's not to say, oh, it's October, let's sort of like wake up from our slumber and decide to do tax planning. We should be doing this all year. We have talked about this all year with Holistiplan. We have a year-round service calendar, right? So all these things that we are building through the year. Having said that, this is it. Right, we're on a calendar year basis. December 31st, the party's over. January 1st, we start all over again for 2025. So the things that we want to do, they have to be done in the next 2.5 months, right? That's it. There's no negotiation. And so time to really roll up our sleeves. Some people who haven't gotten around to this, maybe you don't have the staff in place. Maybe you're just starting with a Holistiplan. I know we've got future subscribers out there. We've been talking about this from January. And so anyway, so now we're going to really, this is where like the rubber meets the road, right? That's it. Okay. So we're going to do some demos today. We're going to talk about wallet share, Roth conversions, and Tax Report 2.0, which is a brand new feature that is super, super cool. And then at the end, we have special bonus material for all of you that will be worth it for you to hang around for. So with that, then here's our agenda for today. And let's then hop in. Is the first thing we're going to talk about is Tax Report 2.0. And so we go here. And with that, then I'm going to let Jen hop in and start demoing while I talk us through it a little bit. So Jen?
Yep. All right. So we figured what better way to show you the Tax Report 2.0 than to go in the software and show you how to set that up. So once we come to our dashboard here, I just wanted to quickly show how to enable the Tax Report 2.0 because it's not automatic. So it's just good to go into your settings. And then you just go to your security settings and you'll see right here your firm preferences, and you could just toggle on Tax Report 2.0. And you could actually make it required if you want to only use that one instead of the 1.0 version, but probably best to have both options. So just toggle on this first thing right here. I
just want to interrupt a second on that. So it says beta, and don't let the beta thing throw you. Tax Report 2.0 is 100% available, but it's not like required. Like you still have an option whether to use it or not. So it's 100% live. It works. And in the new year, is when like everyone's going to be using 2.0. So they're basically giving us this like transition period. So I just want to be clear on that. This is available. Okay.
Great point, Debbie. So just to show you, I'm going to our household tab.
Oh, can we just back up real
Yeah.
quick? I know I'm such a pain, aren't
No.
I?
Yeah, go ahead.
Just back up to that previous slide or the previous, yeah, here.
Mhm.
So welcome. First of all, I love this. I think that's a puffin. And I just absolutely love that. But over here to the right, where you talk about new user orientation, the what, why, and how of tax planning. So again, like we've got future subscribers on today. You know, Holistiplan, like their mission is to make this as easy as possible for you to get up and running with this software. And so part of it is they have monthly classes from myself, where I am literally walking you through every month any new features or the things that you should be doing at that time of year, and then how to incorporate Holistiplan to help you do those things during that time of year. And so for those of you out there who are like, hey, like I've never done this, this is like a strange, like new world for me. I can't think of a software company that is trying harder to make this easy for you than Holistiplan. And their help desk wins the #1 top rankings from the Bob Veary study. We have a bunch of people today on from client service. Emily, Madeline, the team is unbelievable. So anyway, I just want to mention that because you put this on the screen and it's just a good reminder. All right, let's keep going.
Mm-hmm.
I love the
All right.
puffin. That is like so cool.
Puffin is very cute.
I think
All
it
right.
is.
I think it is too.
Okay.
Okay, so going to our household, just gonna click into one here. And you go to the tax return section, assuming you've already uploaded your tax return. If not, you simply click this button, click the year, and simple as that, the tax return uploads in a minute or so if there's no, issues with it. If it was like a weird scan or something like that, typically takes under a minute, very fast to upload. So once it's uploaded, you'll see it here, and you could click report to get to the tax report. So now, since we enabled the settings here, you'll see the option to see tax report 1 and tax report 2. So you can kind of switch back and forth if you want to see both. So for these purposes, we'll look at tax report 2.0, but quickly just scrolling down, this is tax report, the original one. Obviously, it looks great. We've been using it for years. Key figures at the top, the different boxes that you can move around with the different types of income, capital gains, and all of that. Just want to show you that briefly. And then go to tax report 2.0.
So to be clear, right? So Jen just showed us tax report 1.0, like the previous version. And like she said, then we've been using that for years. As an aside, you could see it's white labeled. So you would have your own logo on it. You would not have Taylor Financial Group on yours, right? And then here is now 2.0.
Yep. And you'll see, obviously, it has all the same figures, key figures at the top, which is just a great summary of everything. And now the great new features of it is that it has these nice charts that help show you, the tax breakdown. This top one shows you the different types of income and what percentage that makes up of the total tax bill, which I think is just super helpful in terms of, maybe the client doesn't have a lot of ordinary income and the majority of their income or taxes come from somewhere else. So it's just nice to see that summary here. And also with this chart, you can just download this image itself if you wanted to share it with the client or, internally if you're looking at that. It's just a nice feature if you did want to just snapshot this instead of the whole report. So that's just another nice thing to note. Another chart here, you'll see this one breaks down ordinary income and the progressive tax rates and how the income fills up those different buckets. So this is another just nice visual that might be nice for clients to kind of see how their income is making up their tax bill this year or the previous year. Now we have the gains chart, which, as we know, gains are stacked on top of ordinary income. So this kind of helps explain that and shows you where the client will be in terms of the long-term capital gains brackets or dividends brackets. So that's another great chart. And then same thing with the tax report 1.0. has a nice explanation of the Medicare premiums, which, becomes very important if you're doing the Roth conversion work to be looking at that, because that can really hike up their premium surcharge. So this is another great feature. Then we have the deductions. So another chart, I just think these are great visuals. It's just another way for people to better understand their deductions and how that worked, whether they were itemized or had standard deductions, and where all of their deductions were coming from. Like this person had gifts to charity, their mortgage interests, and the SALT and all of that. So you just see that over here. So really it's these charts that are the upgrade with 2.0.
Which is really cool from a planning standpoint. Like if you scroll back up to the deductions right here, like with Schedule A. Again, I'm a big believer in visuals, so something like this can be very helpful to people. But the other thing that I'm thinking about is as we're closing in on next year and the expiration of the TCJA, we're going to be potentially going back to either the previous tax code or some mishmash of the previous and what we have now, right? Likely it's going to be some mishmash, and that's a very scientific term, okay? And so I think that this report could be that much more helpful when we're either trying to model out what things could look like, and people are so used to now this current regime because we've had it in place since the end of 2017, that it's going to need some relearning, whatever they do at the end of 2025. So I think these reports are going to become that much more valuable because we're going to have a whole new tax code or big parts of it to deal with in just over a year.
Great thoughts, Debbie. So just scrolling down, those were the three major charts that we scrolled through above. Some of the extra information here, Schedule B, Schedule D, if you have any of that. And then you can see this chart is actually very interesting. It talks about the tax efficiency of your investment income. So it breaks it down between dividends, interest, and capital gains, whether long-term, short-term, taxable, tax-exempt, or non-qualified, qualified. So again, another visual to kind of see where income's coming from and what it's made up of. And I just like how these are side by side instead of it's just a nice comparison next to each other.
And again, you can start here and then look to see your tax inefficiency or your tax drag. And then you can go back to the tax return or your investments to see, like, where are those non-qualified dividends coming from? And if it's a high conviction investment that you have, great. But if it's not high conviction, maybe you reconsider whether you need to have all that taxable interest income. Maybe munis make sense, or maybe those bonds should be going into an IRA. So that's that asset location idea. And so this is a great tool to be looking at tax returns.
Yep. So scrolling down, let's get other income here. The Magi considerations, this is all the same as tax report 1.0, just looks a little bit different, but shows you if you're over or under the certain Magi phase outs. So that's here.
And you can hide these if you want. So if you have clients that are exceeding these Magi limitations, or it clutters up the report, you can just hide them.
Exactly. And yeah, anything with that little I here, you can hide all of this stuff or things that aren't applicable. So it makes the report much more streamlined, and the client isn't kind of digging for what applies to them. Deductions and credits here, and then the observations that we love. Again, you can edit these, hide them, move them around, add your own in. So you have a lot of flexibility with the report and can really kind of make it your own in terms of what you feel is a priority. And then state tax hints down here, again, can edit all of those. Yeah, so Debbie, I don't know if you had any additional thoughts on the tax report.
Yeah, so just taking a step back then, like if we go to that front page, is, we definitely got into some of the detail here, which is amazing. But taking a step back then, like just having the tax report for your own internal purposes and sending to clients that makes the Holistiplan subscription like worth it in and of itself. This is an amazing way to summarize these tax returns that literally have become 70 to 80 pages long. Nobody knows how to read them. You're always worried about missing something on the report. And this is a great way to compile, 50, 60, 70 pages literally into, 2 to 3 pages and really thoughtfully done. And then, yes, you can customize this parts of it if you'd like. But this is incredibly valuable to you internally, and really valuable for your clients. So that's my initial thoughts on this. And they just made it better with 2.0.
Mm-hmm. Totally agree. So with that, I think while we're here, starting into the wallet share item and increasing wallet share, we might as well just look at another great part of the tax report is that it highlights Schedule B income, which can show you other opportunities of outside assets that your clients may have, that you may have previously had to dig through the tax report for, and Holistiplan just makes it super easy and has it all listed right here. And this gives you a great opportunity to be proactive with your clients and reach out to them if they have a lot of cash on the sidelines, which is probably likely, because interest rates were so high, in money markets, they might have a lot of extra cash that they want to invest now with interest rates potentially going down. So that is a great opportunity right now. And with us, we started doing this project, I think, back in July, and we've literally brought in hundreds of thousands of additional assets from existing clients, which we know is a lot more valuable and takes a lot less investment than trying to go out and get new assets. So this has been a game changer for us. It's saved so much time by being able to just use Holistiplan to look for this and not just try to hunt this down on our own. And clients were actually very receptive to this, and we're grateful that we were proactive in trying to, do the right thing for them rather than, initially we kind of were hesitant, thinking that maybe they think, we're just trying to get these additional assets, but it really was the right thing to do. And we got great feedback from the client. So Debbie, I don't know if you had just a couple other things on that.
Yeah, so there's like two parts of this wallet share project is what we're calling it, right? So one of it is looking to see if assets are held away. And clients don't tell you about that all the time. Sometimes they forget, like they genuinely forget. Other times they're intentionally not telling you. So that's where you can see the dividends in particular, where you see this client's got Vanguard, they've got Schwab. Well, we custody at Schwab, so we know about the Schwab part. The Vanguard part, I don't know. Did we know about that? And they're doing things even during the year. So even if last year they came clean and told you everything and it made it into the financial plan, you don't know over the last 12 months what they did. And so this is, this is a great sort of record going to the source. And then the other part, which we never had to think about before, but now all of a sudden we've got to think about it again, is the clients compiling a cash, stockpiling cash, which they really haven't done for the last 15 years because it was TINA. There is no alternative. Now, over the last year and a half, these clients think they're super clever and they're building up money market, CDs. I'm seeing it over and over again. Even this week, I sat down with a guy, he had millions of dollars, and he was like piling up all these CDs. Now they're all getting called. And so he had like $1 million of cash because of all these called CDs. He didn't know what to do, right? His clients are thinking they're very clever, particularly the conservative ones, right? The aggressive ones stayed in the market, but it's those folks that are a little bit older, nervous about the market, got caught up in TINA, and now finally they have an alternative, and they're running back to cash, back to CD, back to money markets. They don't even remember. They have it in 5 different banks. Well, now you look here. So, for example, this client could easily have $100,000 to $200,000 of cash. If you look, there's about $5,000 of interest income. So that could literally be $100,000 to $200,000 of cash that they have at these 3 banks. Well, that's money that does need to be in the market. And so this is just a great way to test what's going on, have those conversations. And Jen pointed out that with several clients, it was hundreds of thousands of dollars. The conversations are still ongoing because we're having meetings with a lot of these clients. And so it's literally millions of dollars of assets that are coming into us. And also it's helping us to track. So even if we don't get that asset today because the CD doesn't mature for another 6 months or what have you, like now we're able to track it, we put it into our CRM, and we're able to get this money, particularly as the interest rates go down. So just on a lot of levels, again, this in and of itself is worth the Holistiplan subscription as far as I'm concerned. Like just right here. Those are my thoughts.
Agreed. All right.
I like that. Agreed.
Totally agree.
Agreed.
Let me go back. I'm just going to pull up the slides now. Just go over those two sections. Just make sure we got everything. 1 second. All right.
Yeah, so let's just go through this quickly because we really covered it in the demo. So this is really more for your reference. So we'll just go through slide. So this is just, again, the beta thing. Here's the look at the breakdown, right? The different types of taxes, the different types of income. We looked at that. And then wallet share. I think we did cover wallet share last week. We're going to keep going through this. So this is just, when I say last week, I'm sorry, last month. But this is just a reminder of the things that we use the Schedule B for. Here's the actual Schedule B. Here it is, so much nicer in Holistiplan. And then, that's pretty much our proactive outreach for these clients, right?
Yeah, and Debbie, I just wanted to point out here in our email, the subject line we put was "Put cash to work with TFG during the market downturn." So I think we just positioning it that way was honestly just perfect. And like, it's true. I just think instead of saying, hey, we saw you have these other assets, you're showing them that how it could benefit them as well. It's not just us looking for this additional money. So I just wanted to point that out. I thought that was great.
Yeah, our timing was very good when we started it because it was July and that was that like 3-week market pullback. So yeah, that's what we used then. Obviously, we couldn't use that term now because the market hit another record yesterday. But again, there's so many ways to be thinking about this. If you're going to send the email out to your clients and be like, hey, like we were reviewing your tax return and we see that you have all this money sitting in cash, basically you'd say the Fed's lowering interest rates. And so you're not going to be able to get these interest rates going forward. So we need to get together and plan a long-term strategy. And we did also include that in the email as well, because we knew the Fed would be lowering interest rates. We sent this out in July and early August. And so, so a lot of ways to come at this.
Exactly. All right. So
good.
Now,
all right, let's hop into some of our year end. So, so a couple things then. So we're going to talk about 10 year-end tax planning strategy. And the first one is, and some of this is really, again, tax plans are year-round sport. I'm including it here, but these are things we should be talking about, year-round, and Holistiplan is. So number one is creating tax diversification, right? Working with clients, shifting investments from those large IRAs to taxable or Roth accounts, right? So always having that in the back of your mind, and then leading into that is performing the Roth conversions. So 'tis the season, right? It's Q4. If we're doing Roth conversions, we're doing them now. And so with that, then we're going to hop in and demo the Roth conversion tool for you.
Yep. All right. So this would be done in the scenario analysis, which is our favorite tool. I use it almost every single day. To get there, you go to the same place, you go to the household record, and you simply go to the scenario analysis. You can create a new scenario. Of course, for these purposes, I already started one, so I'm going to click into that. So if you've never been in scenario analysis, what you typically would do is, of course, when we're doing the Roth conversion analysis for the client, we want the most recent tax return to refer to, because there's, as we know, a lot of moving parts, and we want to make sure we have the most recent data to refer back to and kind of have that here. So when we start, we always add so for this year, it'll be 2023 tax return. You would just simply click this button, load tax return, and you could just select the year that you want to put, and it will populate right here. So that's kind of our first step when we're doing this Roth conversion analysis. And then you would, to create another scenario for the base case for this year, you would just create your own blank scenario. I've already done that. So from the last year return, we would create a base case for this year. Of course, changing all relevant information, such as making sure the year is correct. And then you could alter all of this data as needed for any changes based off of the current year tax projection. So whether that's wages, interest, dividends are going to change, if they have any pension income, Social Security income, any gains, you can input that all, and you could just click into each item and simply manually input those numbers. So it's very quick and easy to do. So once you set your base case, this helps you have a view of what their base tax projection is going to be. So you know kind of what you're working off of. So in this case, you'll see that if you scroll down, taxable income, total income, and then the projected total tax and the projected marginal bracket that they'll be in. So these are some critical things, of course, that we're looking at if we're doing the Roth conversion analysis. You have the state information down here, and then again, that MAGI and the Medicare premium section here, which is important for those older clients who are on Medicare and could be subject to the surcharge. So once we have this base case, we can now play around with the Roth conversion amount, and you'll see that item right here, and you could just input any number you want. So it's also nice that you can see these all side by side to see the differences. So I'll pull up the one that I built, and just another note, you can save these strategies in the bank right here. So it's nice if you want to remove one, but don't want to delete it completely, you can save it here, which is what I've been doing. So it's great. You don't have to recreate it again. So if we have a client, so this client was in the 12% bracket, and say they don't have such a large IRA balance and we're just looking to maximize the bracket, Holistiplan has a great feature called Solve for Max. So you simply click this button and it will tell you how much additional income in room they have to get or to fill up that bracket or until they hit the next bracket. So you'll see here, to fill up the 12% bracket, it's only $13,000 of income, of ordinary income. And then you see the Medicare premium breakpoint. So if that's something that's critical to the client, this is the amount until they get to the next surcharge bracket. So this is a great tool because it just in 10 seconds, you see how much income it tells you to fill up the bracket. And you could just run a scenario if you want to just do 10,000 this year, if you just want to do a small conversion. So for these purposes, I just ran a $75,000 Roth conversion just to see where that puts us at. So if you scroll down, you'll see the difference in taxable income. So 117 to 192. These are the key items that, we highlight in our report when we show the client total tax right here, and then the marginal bracket. So you'll see this put them in the 22% bracket. And you can calculate the additional taxes that would be due. And you also see the difference in the state taxes here. And then, like I said, the Medicare premium. So you'll see they weren't subject to a surcharge, but now they're in that first surcharge bracket, which may not be a big deal, but it's just good to note that they're probably going to have to pay a little bit more. And Debbie, I don't know if you want to just add any thoughts in between.
Yeah, so why don't you tell our listeners how many scenarios you're able to build here on the screen side by side?
Yeah, so I think you can fit 6 like within the software if I'm doing it right now. But when you go to print the report, it will only show be able to fit the 4 side by side on the paper, of course, because it's not it can't hold all 6, but it is nice if you are on the screen. You could show 6 and then the 4 max when you print it out.
And they have the Solve for Max feature, which is really nice.
Yep, the Solve for Max feature, very nice, as we showed you. So sometimes we'll kind of play around in here. They were in the 12%. I just put 75 here. And then I want to just see how close they are to filling up the 22% bracket. So click the Solve for Max button and we will see, okay, 18,000. So let's say we want to max out the bracket. We could do I would tell them, okay, you have about $10,000 in room, just give or take a little buffer. We usually like to give 5 or 10. So then I could just increase this to 85 now that I know there was a little bit more room and we're maximizing that bracket. So it's just a very easy tool to use and saves loads of time.
Yeah, and the only other thing I'd mention here, it's more of a practical thing, is when you're recommending Roth conversions, like very few clients are like, yes, like I want to pay a lot of taxes right now, right? So there's a little bit of negotiation back and forth with the client. And again, that's where the scenario analysis is so helpful, because we're not just like, yes, you will do a $250,000 Roth conversion, job done, right? It just doesn't work like that. And so that's when we'll play around with it a little bit. I'll say, look, our recommendation is 250, but here we modeled out 125, and that's where the scenario analysis can be helpful. So just as an aside from a practical standpoint.
Yeah, and I'll just say, oftentimes we'll send the analysis via email and then we'll have a meeting and the client, say, what if I do X amount? And many times I have done this live. As you can see, it's very easy to do rather than send the client home. They're still thinking about it. You could do it right in the meeting, just show them what it looks like, boom, get it done. So I just also really like that about it because you can just do it in real time.
It's great.
Mhm.
Great. Thanks, Jen.
Yeah, sure.
And we're going to show the Roth conversion explainer tool.
Yes. So let me just show you that quickly. So in that same Roth conversion button, you click into there and then you could go to the Roth explainer right here. And we start it and then it will ask you for a bunch of, info so that it can give you a better recommendation. So it'll ask you, okay, we input the Roth conversion amount, shows you the total tax of the Roth conversions. You can put their current taxable asset information, the cost basis, all of their tax deferred monies for each of the clients, and then any Roth assets that they have. So it's just kind of a nice step-by-step data input here. And then you can assume a rate of return, annual rate of return. You could do that whatever you want. Any portion of capital gains, life expectancies, Social Security for each client here. And then the last stage would be their spending assumptions, the inflation, and their projected, tax rate if based out their tax deferred accounts. So after you input all of that information, you could get the projected taxes here. This one here, let me just put this stuff in here. And then it will project the taxes out for you. And of course, you will probably need to use this in tandem with your accumulation software, whether that's eMoney, Money Guide, whatever you're using. But it just shows you the difference in the Roth assets and the projected taxes and the tax deferred accounts versus not doing a Roth conversion versus doing a Roth conversion and projecting out for the lifetime. So that's what the tool does. As you can see, it's pretty quick to do and just gives you a nice little graphic here to use with the other software.
Yeah. And I love this because look at these taxes down here, right? Like $5 million in projected taxes. This is the work that you're doing that's so valuable, saving the clients, so much in taxes and helping them to build their wealth. So it's just huge.
Exactly. Yeah, that's everything here. I just wanted to make sure. And you could print this as well if you wanted to, and you'll just get a PDF of that if you want. So that's nice. All right.
That's great.
I'll just pull up the slides, Debbie.
Yeah. So as Jen hops back into the deck, then the third of the 10-year tax plan strategies, and the first 3 are all tied in together, right? Is thinking about tax diversification. And again, this is part of your year-end meetings with clients, some of the things you should be looking at, right? Is making sure that not all of their money is in that tax deferred account. So just high level thinking about that tax diversification, the 3 different buckets: tax-free, taxable, and tax deferred. And then you're performing those Roth conversions, which we just demonstrated, and then the asset location. So we have clients, and when we're doing the Roth conversions, for example, they might have a traditional IRA, and they're really excited about their technology company, let's say, right? Whatever the tech stocks are. We're like, well, when we do the Roth conversion, then we're going to convert that technology stock because we'd rather that in a Roth than in a traditional IRA. And so there's lots of ways to think about these first three, and they sort of work together. But really the idea is that you want to think about tax efficiency, and how you want to think about this is with the end in mind, is what I say, right? And so that's where Jen even showed you the demo, the Roth explainer tool, is clients are a little bit complacent. If you show them what their future could look like, we call that ghost of Christmas future. If you show them, hey, you could be paying millions of dollars in taxes, and you're able to show that to them, then they're going to be listening to you and more apt to engage in asset location, Roth conversions, things like that. But sometimes you have to prove it, and now you have the tools to prove it, whether you're using Holistiplan or you're using their accumulation software. And basically, if you set them up in their accumulation software, right, eMoney, Money Guide Pro, and you show them, hey, you've got this $2 million traditional IRA or this $1.5 million traditional IRA, and every year you're putting all this money into your 401k. And if you keep doing that, by the time you're 73 or by the time you're 80, you're going to have an $8 million, retirement account. And your first year, the RMDs are going to be close to $400,000, right? If you start walking them through, again, ghost of Christmas future, they're going to see things in a way that they never saw them before. And that's going to help them be loyal to you, pay attention, helps you to get more assets over, because if you're going to do this work, then you also are going to talk to them about bringing their additional assets over. So all of it sort of works together. All right, let's go to item 4 then of our 10 year-end tax plan strategies. So consider tax loss trading and gain harvesting. So I know what you're thinking. You're like, Debbie, the market just broke records yesterday. How am I supposed to do tax loss trading? Totally get that. Might be hard to do on an S&P 500 index fund, but there are other things in clients' portfolios that might not be doing so well. Maybe they have some small cap value or some commodities, right? Or maybe they're just really lousy stock pickers. So I sat earlier this week with a prospect that had losses in every position in his portfolio. And you're like, Debbie, you're exaggerating. And I'm telling you, I'm not. So my little Maxie, my cat Maxie, he's actually not so little. He literally could have done a better job picking stocks if I just put 5 pieces of paper in front of him and he put his paws on the ones that he liked, okay? Literally, there were losses in every single position. So believe it or not, like that's still out there. We'll have new clients come to us also, and their previous advisors never took some of those losses from positions that are in that portfolio, maybe not even paying attention to some of these positions. And so you want to take an eye. You want to look, even if a position has a gain or a portfolio has a gain, maybe you look into the separate tax lots. So just don't sort of brush this off and be like, hey, we broke records. There's no opportunities here. Sometimes you have to mine around for them, but sometimes they're there. And then capital gain harvesting. This is for your clients in very low tax brackets. And this is one of those untold stories which can really demonstrate great value for these clients. And again, this is where Holistiplan really shines, because in the old days, you're not going to dust off a tax return for somebody who's in a very low tax bracket, isn't feeling a lot of pain, maybe not bringing it up. But with Holistiplan, you can identify clients in the 0% capital gains bracket. Like, why wouldn't you sell, some of that Apple or some of that really appreciated stock, if of course they want to diversify or there's concentration risk, whatever. But there are opportunities there that people don't realize in that 0% capital gains bracket, right? So that's just one example. All right, benefits plans and Roth 401ks. And so benefits plans are starting to get released now, okay? I know I'm starting to get some things into my inbox this week for the company. So this is a great time to be reaching out to clients and offering your assistance in reviewing their benefits plans, particularly the items that are tax favored, right? Is paying down student loan debt by the $5,000 tax free. Also, what types of 401ks to select, employee stock options, employee stock purchase plans, right? Lots of things that are baked in there. And a number of them are tax preference items, deferred comp, right? So let's take a look at those. And let's think about Roth 401ks for future contributions. We're going to get to a little more of that in a second. And then maximizing those retirement plan contributions before the end of the year, right? So you have until the end of the year. If they're a little short, they can call payroll, call their HR department and say, hey, can you put an extra $3,000 in each week for the next 3 weeks because I didn't do it earlier in the year or what have you. So let's make sure we take advantage of that and the catch-ups. Good. Health savings accounts, right? Right. So we want to make sure that we invest all the money we can into the health savings account, basically a Roth for medical expenses. So again, another opportunity, tax-free growth. We want that. We want to do our distribution planning before the end of the year. And so we want to make sure that we are pulling down these traditional IRA accounts in a thoughtful way. And that could be either doing Roth conversions or taking distributions from those accounts or a combination of those. And so that whole rule of thumb of don't touch that traditional IRA, that's the last thing that you go to or whatever. Like, no, you want to be pulling down those balances because they create trouble down the road. Let's take a look at those annuities. Interest rates are starting to go down, and it's starting to get reflected in a lot of accounts from insurance companies, from banks. So if you have clients that are interested in annuities and it makes sense for them, then now could be the time to lock in some of those interest rates before they keep going down. And then the estate planning and gifting, which we're going to talk about in the next section. And so again, the end of the year, December 31st, if we have gifting, if we have trusts we want to set up, then year end, calendar year end, is the time we need to do it. 2025 starts a whole new chapter. And so we might have a little bit of a rush to the finish line here too. $18,000, per person. All right, let's hop into then the tax shakeup for 2025. Key changes you can't afford to miss. Start with inherited IRAs. This is a little bit of yesterday's news, but I have to include it in here for the sake of completeness, right? Is in July, we got that guidance that we've been waiting for years. We covered this extensively with Holistiplan in August. So if you want details on this, go back to our August presentations. But here are some key rules in connection with the inherited IRAs. This has been covered a lot, but here's the bottom line. Yes, the 10-year rule still applies, but we also have those RMDs beginning in 2025. So as you come into the end of the year, as you're having your year-end meetings, and as you're preparing for 2025, new on your agenda now is RMDs for those inherited IRAs for the non-eligible beneficiaries, right? The designated beneficiaries are still protected, not subject to the 10-year rule. That's the spouse. That's somebody within 10 years age of the deceased. That's a minor child, not grandchild, but a minor child. And that's someone who's disabled or chronically ill, right? So those folks, eligible designated beneficiaries, not subject to the 10-year rule. But for the most part, everybody else is subject to 10-year rule and the RMDs. Remember, no RMDs for the Roth IRA, for the Roth IRA, right? No RMDs for that. So an inherited Roth IRA, we don't have to worry about the RMDs, but still need to be pulled down within the 10 years. Okay, so that's then the inherited IRA. Secure Act 2.0. So this had 100 provisions in it. It was just a total smorgasbord, right? Just everything was thrown in, and a lot of it there was no rhyme or reason. And so just want to highlight things that are kicking in 2025 and 2026, because there's all these effective periods, and every year there are 5 or 10 new provisions. And so for 2025, I'm going to go through these quickly. You have the deck, but again, just a little bit of a reminder, right? Automatic enrollment for retirement plans starting after December 31st, 2024, right? Initial contribution minimum is 3%, could go up to 10%, but now we've got automatic enrollment. So think about this for plans that you're putting in place. Think about this for your clients. Ask about it. They might not tell you about it, right? So think about this, okay? You will have to affirmatively opt out if you're not interested. Okay, the next one is Roth accounts. And so the Secure Act 2.0 basically equalized the treatment between a Roth 401k and a traditional 401k. If you remember, previously Roth 401ks had RMDs. That was ridiculous. Now the Roth 401k does not have RMDs. nor does, of course, a traditional 401k. I'm sorry, that's wrong. Nor does a Roth IRA, right? We know that. Here's the challenge. This is not written down. So stop, listen, and you got to write this down. As part of this guidance, what the IRS said is that if there is some type of hybrid account, those are my words, hybrid account, where there's Roth 401k money and traditional 401k money in the same account, they're going to continue to treat it as if it's a traditional 401k and require RMDs. Yes, you heard it here. This is buried. It is hard to find. Folks are not talking about it, but it is in there. Okay. Now, my belief is probably the IRS doesn't have the technology, the computer system to be able to figure that out. So they decided, hey, we're just going to treat this all as if it's a traditional 401k. So even though we're out there and the headline is Roth 401ks, no RMD, that's the headline. When you read into this, okay, if you have, again, I'm calling it a hybrid account, we have some Roth 401k and some traditional 401k in that same, in that same account, they're going to continue to treat it as a traditional 401k and require RMDs. And what this means then is those clients that have been contributing to the traditional 401k and contributing to the Roth 401k, when they retire, they still need to get that money out of there. Otherwise, RMDs are going to be required on the Roth 401k. So you're like, Debbie, what does this look like? Well, I can tell you what it looks like because this is my account. I have all this traditional 401k money, but I have all this Roth 401k money in there as well. So they would try to do that to me if I wasn't paying attention. And they're going to try to do it to your clients as well. So something to be thinking about. All right, let's go to the next slide then. We have a higher Secure Act, a 401k limit. This is bonkers. So I'm going to call this the donut hole. Let's go to the next slide because the picture is worth 1,000 words. And if you go down to age 60 to 63, you see this. This is a projection for 2025, right? Because right now it's $23,000 is a deferral. So we're going to assume it's 24 for next year, right? Whatever. Okay. Do you see that catch-up limit for age 60 to 63? This weird donut hole, basically 60, 61, 62, 63 for 4 years. You get to put in the $11,000. So quirky, weird, hard to remember. Make sure you make a note of that and make sure your clients know then to take advantage of this for starting in 2025. Good. All right. The next Secure Act provision, again, it's just like total hodgepodge, like no rhyme or reason to a lot of this stuff, I think, is the catch-up contributions if you're making over $145,000 in the previous year. And the catch-up has got to then be to a Roth 401k, okay? Got to be to a Roth 401k. Now, remember, they originally had this effective, I think, for 2024, and then everyone's like, how are we supposed to implement this, right? All the payroll companies. And so they pushed it out to 2026. Again, should be on your radar screen. It's not 2025, it's 2026, but again, should be on the radar screen, part of your planning, part of talking to clients about this. All right, let's hop into the granddaddy of them all in this last 10 minutes is the sunset of the TCJA. When this was passed at the end of 2017, 7 years ago, we're like, oh, sunset, that's like a decade away. Yeah, well, the decade's up, basically. I mean, it wasn't literally a decade, but it was pretty darn close, and it is here, okay? So if you've got estate planning issues with your clients, if they're in the splash zone, is what I call it, if they could be in jeopardy with that lifetime exclusion being cut in half, then they need to do planning, and they probably should do some of it now. I'm not saying all of it, but I'm saying if they were going to do some gifting anyway, if they were going to create up some trusts anyway, then why don't we do a little bit now? Let's engage that estate planning lawyer. Let's get that low-hanging fruit. Let's have these conversations, and let's be teed up, because Congress does not give us warning when they pass tax legislation, right? We know that from the last several years. So here are high-level provisions that could go back. Here's what the best thinking about the TCJAs, right, is it's got to sunset at the end of next year, right? That has to happen. So they get to the table. Are they going to be able to reinstate the entire TCJA? Probably not. The whole point it had to sunset was the bird rule. They can't afford it, okay? So that's the whole point. They had to sunset. So are they going to be able to go back and reinstate it? Probably not. But are they going to probably pull provisions from it and try to keep those alive? Yeah, probably. That's where the horse trading is going to come in. All right. And of course, Holistiplan is going to keep you apprised every step of the way. Okay, let's go to the next slide, some of the key provisions here. So again, lifetime exclusion, technically TCJA expires, lifetime exclusion gets cut in half. What was no longer an issue for us now might become an issue. You've got $6.5 million for somebody that's single. That's not a lot of money, particularly in those high rent states like California, New York, New Jersey, Massachusetts, whatever, right? And then for a couple, of course, that could go down to $13 million for the couple. Again, that's a lot of money, but for some of your clients, they might be butting up against that. And if that's the case, we want to be on top of that. Let's go to the marginal brackets. This is going to affect everybody, right? So that last slide, lifetime exclusion, you're like, oh, you might roll your eyes. That's not my clients. It doesn't affect them. Well, this one does. So let's take a look at this real quick, because this is pretty interesting. So let's just take some of the dollar amounts. By the way, as an aside, about 70% of taxpayers pay less in taxes as a result of the TCJA, 70%. So even though people say, oh, it benefited the rich, blah, 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 and in many respects it did, at the end of the day, 70% of your clients are paying less taxes as a result of the TCJA. And so this is where I think there's going to be a pitch battle over the next year and a half around the TCJA. But let's just take some dollar amounts and see how this would affect your clients. So you've got a client making $289,000 a year, taxable income. This is married filing joint, $289,000 a year. They'd go from 24% to 33%. Oh, I don't really like that so much. Okay, let's say you have a client making $383,000 a year. They're also in the 24% tax bracket because it's so darn wide. They would go also to 33%. Now, let's say a client is $700,000. They would go to 35% now to 39.6%. Okay, so we're seeing at this upper level, really from like $300,000 of income up, these people marginal rates are going up by anywhere from 5 to 10%, the marginal rate. Okay, let's look at people near the bottom. If you are at that 10% rate, you get left alone, right? Whether TCJA expires, the old, the new, you're left alone, right? But if you're at the 12% rate, that dollar amount, you would get bumped back up to 15%, okay? Bumped up to 15% from 12. Same thing, 22 would go to 25%, so you're still feeling some pain down there. And then at that 24% tax bracket, this is where TCJA widened that 24% tax bracket and added basically $100,000 into that bracket, which is why it captures so many people. So many people are in that 22 and 24% tax bracket, and that's just not tenable. So when I sit here and say to you that 70% of folks pay less in taxes under the TCJA, look at this. It's basically at the 12%, the 22%, the 24%, 35, 37, you're getting the picture. Is almost at every single level, you've got people paying, less in taxes. And so it's going to be very interesting to see how this comes out. Let's go into some of the details. The standard deduction was doubled under the TCJA, right? That really helped people that don't itemize. It helped a lot of the red states, people that don't have high real estate taxes, don't have high income, estate income taxes. Really hurt some of the high rent districts is what I call it. It's going to be very interesting to see because this is, very politicized, this whole SALT deduction. And so we're going to have to see how they handle that. Tax credits, TCJA became very generous with the tax credits, allowing a child tax credit up to $400,000. That's crazy, okay? Tax credits had always been for middle class, lower class folks, and now we've got tax credits up to $400,000. Now you can see why it's been so expensive and why it had to sunset according to the Byrd rule, and now how there's going to be a lot of battling about what's going to stay and what's going to have to go. Let's talk about tax deductions on this next slide. And so we talked about SALT, right? Currently capped at $10,000. Prior to that, there was no SALT limitation, by the way, that goes back to the original tax code, right? Back to the original tax code, 1913, is no SALT limitation, okay? That was a major change. The mortgage interest deduction got limited under TCJA, again, hurting those more expensive states. Charitable giving, okay, 60%, 50%, fine. Medical expense, 7.5%, 10%, that's fine. miscellaneous deductions. They did away, if you remember that subject to 2% AGI on the bottom of the Schedule A, they did away with that at TCJA. And so it'll be interesting to see. Remember, that's where clients could deduct their advisory fees, which I love that they could deduct those. Now they can't anymore. I'd love for that to come back. All right, the next one is the estate gift tax exemption being cut in half. We talked about this a little bit. Let's go to the next slide here. Here are 4 strategies that you could be talking to your clients about. So these are like the go-to strategies. So clients that are in, again, that splash zone, if you've got a couple that's at like 10, 11, $12 million, if you've got a single that's at 6 million, but particularly that couple, right? They're probably not going to spend through their 10, 11, $12 million, right? Here are like the go-to strategies, right? That QPERT, remember that's your principal residence and a vacation residence. You can do it with 2 homes, okay? That spousal lifetime access trust, the SLAT is like freaking crazy genius, okay? And so for folks that might need to be doing estate planning, but don't want to give up all the control, the SLAT can be genius. And so look at the SLAT. It allows the couple to still benefit, but get it out of the estate. Yes, there are wrinkles with the SLAT, but if you draft it properly, you can be protected. The charitable remainder trust can make a lot of sense. And then the GRATs, if you've got an asset that you think is going to appreciate in value. So these would be my 4 go-to strategies. The first 4 things that really hop to my mind. So the idea here then is let's be proactive. Let's have those conversations now. And remember that there is no clawback. So if we do gifting now, if we set up trust now, and they change those estate planning laws, and they cut that lifetime exclusion in half, you are grandfathered in, right? So something to think about. And as we wrap up the hour, our bonus material, so we put this together. This is our year-end planning items announcement. We sent this to clients. We sent this to clients just last week. Gosh, I was going to say last month. It's amazing how time flies. But we sent this to clients, sort of our year-end, like, hey, this is what you all should be doing. And so this is bonus material. I think it's worth its weight in gold. And with that, then there is a special discount code, Debbie Taylor 2024, for 10% off in 2024. It is not too late to get Holistiplan now. You can just roll up your sleeves, dig in. I have junior people at my office help me. Jen is not so junior anymore. She's been with me for 5 years. But I have them starting when, like, literally their first day, they're working on Holistiplan. It's that easy to use. And honestly, going into Q4, it's worth its weight in gold. And so with that, last slide, fortune favors the bold. Thank you, everybody. And back to Laura.
All right. Thank you. That was an awesome presentation. Thank you, Debbie. Thank you, Jen. I mean, we covered the tax report. We covered scenario analysis. We covered the Roth conversion projection tool, TCJA sunset, and the Secure Act. Could you ask for anything else?
I'm exhausted.
That was amazing. Thank you. Thank you, both of you. And then thank you, everybody who showed up today. We really appreciated your time. As always, we'll send out the recording. We will send out the slides within the next couple of days. So keep an eye out for that. And yeah, we'll see you next time. Thanks, everyone.
Thanks, folks.
Thank you.
Stay safe.